Hey everybody, what's up? It is Monday, January 13th. I took a couple of days off last week from making these videos. You know, folks, there's not like stuff to say every single day. There's not like some important analytical perspective day to day. I'm a macro guy, so I like to look at the big picture. And so sometimes it's just good to reflect. And also, I've been watching what's going on in Los Angeles. What a horrific situation out there. If any of you who are out there, my thoughts are with you. And stay safe. And really, it's just like unimaginable devastation. Really incredible. And, I just think of those brave firefighters and first responders. My dad was a firefighter in New York City, and every 9/11, I always think about him, about those brave 343 firefighters that ran up into those burning towers and lost their lives trying to save people. Those are real heroes, folks. Real heroes, not your Hollywood movie stars. It's not your sports athletes. It's the people that we often don't even give tribute to. And, it's times like these when, you see who the real heroes are. Anyway, let's talk a little bit about the markets. I want to step back and I want to just give a macro perspective. Like, since the election, there's basically been a one-way trade in all the markets. Actually, it probably started before the election after the Fed's first or second rate cut. Remember, the first rate cut was a 50 basis point rate cut. Then that was in March, and then they followed that in May with like a 22 25s. But the trade since the election has been a one-way trade based on everybody believing there's going to be a resurgence in inflation. Like, all the markets are reflecting this. Bonds, especially the bond market is on tenterhooks. It's just been hammered on this inflation outlook, and the Fed has contributed to that by its signaling, its communication, Powell's statements and comments from other Fed members about problematic inflation and turning hawkish. Just on a side note, if the Fed wants interest rates down, it's a very simple matter. They just keep cutting rates. But this is not the institutional orthodoxy of monetarism. And, I've been over this so many times, that the monetarist orthodoxy is that you attack inflation by raising interest rates. And of course, this is ludicrous. And there's so many examples. I've spoken about this a million times. There's so many examples around the world where it's really the exact opposite. We've seen for years and years central banks in Turkey or Argentina and other places trying to squash inflation by raising interest rates. And the only thing that happens is that inflation goes higher, the currency gets destroyed. But here we have the Fed and a lot of other major central banks, with the exception of Japan. But even now they're starting to turn in that direction. That are just following along the same path, and that is a path that leads leads to an outcome that is opposite of what they're trying to achieve. So here we are again with the Fed now definitely in a state of pause when it comes to any further monetary adjustments or rate adjustments, and probably leaning, I wouldn't say towards a rate hike, but definitely with a hawkish outlook. And this signal being transmitted to the market is what's causing the bond market to go down. It's what's causing longer term yields to go up. The Fed is basically reinforcing this view. So here's the thing. I am taking an opposite position. Like I said, since the election, this view, which is now universal, pretty much universal, that we're going to have a very significant resurgence in inflation. And this view is reflected in the markets. It's reflected in bonds. It's starting to be reflected in stocks now, with stocks going down because of interest rate fears. You know, we see gold starting to bounce back. We see oil starting to bounce back. I don't think it's going to happen. And, you know, everybody who is betting on this outcome, they're basically looking at what Trump has proposed as policies during this campaign and since the election. And I keep saying, like, we don't know what policies eventually are going to, you know, come to fruition. We're hearing things. We're hearing about tax cuts. We're hearing about tariffs. By the way, we're also hearing about spending cuts. I mean, Mike Johnson, Speaker of the House, said, you know, they're going to have to look at, they're going to be looking at big cuts to Medicaid and these programs. We don't know what the policy mix is going to be, number one. Number two, I have to, you know, take a look at and put into the equation what's going on in Los Angeles. I mean, you have a major metropolitan center, an economic center, an important economic center for the national economy, basically shut down, or, you know, to a large degree shut down. There's not going to be any immediate financial assistance or economic aid coming out of Congress. As a matter of fact, some members of Congress now are saying that the only aid that California or Los Angeles is going to get is going to come with conditions. Okay, so this is going to be a process that's going to have to be hammered out in Congress. You know, it took a long time for the aid just to the hurricane affected areas. I think that, you know, that was the spending bill that was recently passed in early January. But those hurricanes and those storms, you know, they were in July, they were in September, they were in October. So, like, it's a long way from any federal aid going to California at this point. And in the meantime, like I said, you have a major metropolitan area, a very large economy, basically shut down, or at least partially shut down. We're going to see these numbers pop up in the economic data. Now, again, everybody is positioned for this massive spike in inflation. The bonds are on tenterhooks, as I said. We're going to have an inflation report coming out on tomorrow on producer prices and Wednesday on CPI. So this is a deep, broadly embraced bet in the markets. And all of my best scores that I've ever had when it comes to trading, investing, have been when I go against this kind of mass view on things, which in many cases I don't think is very well thought out, or at least in this case, I don't think it's very well thought out. There could be some significant spending cuts in the fiscal package that Congress passes. That's what Trump wants. That's what Musk wants. This is what Speaker Johnson is alluding to now. Okay, so that's not even being dealt with. That's not even being spoken about. Everybody's talking about the tariffs. Everybody's talking about, tax cuts or whatever. So I'm taking a bet against this broad trade that's going on right now, a very concentrated trade. And to me, again, just not to repeat myself over and over, but this reminds me a lot of the bearish trade when the Fed started to raise interest rates in 2022, okay? And remember, you had all these geniuses from Wall Street, this guy Mike Wilson from Morgan Stanley and everybody else saying this was going to be a recession. 100% belief that there was going to be a recession. Coming into 2023, that was a universal forecast that there was going to be a recession. I said as long as the Congress raised the debt ceiling, there was not going to, by the way, we have that to deal with as well. I mean, January 15th, which is Wednesday basically, is when Yellen said, you know, thereabouts, January 15th is when she's going to have to start engaging with the extraordinary measures to continue payments. So that's not even, that's not on anybody's radar screen. I'm not hearing anybody talk about that. So I'm a contrarian. And when I see things that are kind of universally accepted, trades that are one-way trades, and I'm not saying they're always all wrong, they could be right, but I look at the evidence. I try to look beyond what the superficial claims are, what the superficial analyses are. Try to look beyond that. Try to see if there's something that they're ignoring. Is there something that they're not picking up on? Are there things that we just don't know yet, which could be a factor in the upcoming environment? This is what I'm saying. And I think that this inflation trade, I don't think it's going to work out. I think that everybody is positioned right now in an extremely emotional fashion with a very superficial analysis based on a view that we don't really know yet in terms of policy. We have to see what that mix is going to be when Congress finally passes something. When is that going to be? In the meantime, we have the Los Angeles fires. We have that whole city basically shut down, or at least partially shut down, a major metropolitan area, a major economy. I mean, there's a lot of stuff going on here that I just don't see how, people are so, committed to this. Like we already know all the moving parts. We don't know all the moving parts, okay? But there's a deep, deep commitment to this trade right now. And when I see stuff like that, I mean, wild horses can't stop me from going against that. I'm not saying it always turns out to be right. It may not turn out to be right. They might turn out to be wrong. But most of the time, when you see an intense concentration of positioning or outlooks where it's like universal, and that's what it is right now. I don't see anybody out there, with the exception of myself, saying like, we're not going to have inflation. We're going to see an economic slowdown because Congress is going to come through with massive spending cuts. We have fires in a major metropolitan economy that is shutting down that economy, or at least partially in a significant way, reducing the economic activity in that. I don't see anybody talking about that stuff. All right? I just don't. I see inflation, inflation, inflation. Meanwhile, we'll get the CPI on Wednesday, but it's supposed to be like core CPI that's without food and energy, year over year, 2.7, 2.8%. That's what it was the last time. That's basically where we've been. And, it would be lower if the Fed lowers interest rates. It's funny because they say, inflation is kind of stubborn. It's stuck at a level. Yeah, it's stuck at a level because you haven't reduced interest. If you take interest rates down, inflation will come down because, once again, I'll repeat it, the cost of credit is reflected in the cost of all goods and services. Whatever the rate is, that sets the general price level. If you raise interest rates, it raises the general price level. If you lower interest rates, it lowers the general price level. So we'll see. I mean, I don't put any faith in the Fed at understanding this. They'll continue to be so-called data driven, even though, the data is pretty much where they want it at 2.7, 2.8%. It's got to come down a little bit more to hit their 2% target. But the trend has been that it's been going down, since it peaked out. When was that? 2021, 2022. So I don't put any faith in the Fed and catching on to that and doing the right thing. But I do believe we're going to start to see the data reflect a weakening situation, and eventually they will have to respond to that. And I don't see any, this massive spike in inflation that is now being reflected in bond yields. I just think that's way off course right now. And that is my bet. All right. And nobody else that I know that I can see is out there doing it. I'm alone on this, which I usually am anyway, just like I was alone in late 2022 and all of 2023. You can go back and watch my videos from that period. If you were a subscriber during that period, you know what I said. I was bullish, stay in the market. I had people saying, thank you for keeping me positioned correctly. I had a guy saying we had representatives from one of the big Wall Street firms coming to his company, which was an asset manager, telling them, stay out of the market, be short. That was not the thing to do. So, yeah, it's me against what seems like the world right now, or certainly the institutional investor. So we'll see what happens. But so that's my bet. Anyway, that's it for today. Please like and subscribe. Thank you if you've already done that. And don't forget to go to my website, pitbulleconomics.com. Sign up for a 30-day free trial to MMT Trader. By the way, if this trade works out, that would be back-to-back the 2022-2023 bullish trade in the face of rising interest rates. And if this works out, I mean, that's back-to-back grand slams. But we'll see. Too early to tell. But I'm pretty confident that it will. But at least, let me just say that we got to wait. We have to wait to see what actual policies are passed. I might, if Congress comes up with a very significant fiscal package and tax cuts and modest spending cuts, that could change the equation, okay? Not to say that growth is necessarily inflationary, because it's not. That's another thing that I've been talking about recently. Like, growth equates to more output. If you have more output of goods and services, that doesn't necessarily automatically mean that you're going to have, higher prices. I mean, that's called capitalism. I've been through this like a bunch of times too. Like, you can't automatically say that growth necessitates or leads to higher interest rates. No, that's completely false. There's no correlation there. Unless you throw in another factor, which is like something's broken in the economy, there's some sort of impediments or obstacles to production. You don't have enough labor, you don't have enough resources, you don't have enough productive capacity. If you throw that into the equation, well, then you're not even having growth, right? But growth doesn't automatically and necessarily lead to inflation. In fact, it's the opposite. Growth means abundance. Abundance means more supply of things. So prices go down, right? I mean, when you look at history, I mean, the first mobile phone I ever bought, I was living in Switzerland at the time, it was like $4,000 for a shitty mobile phone. It come all the way down. Same thing with computers. The first computers were thousands and thousands of dollars. They've come all the way down. Same things with TV sets. Same things with many, many things. Abundance means more supply, means prices come down. So let's see what happens. Anyway, that's it for today, folks. And once again, for all of you, anyone out there in Los Angeles, please stay safe. My thoughts, my prayers go out to you and to all those brave firefighters and first responders. Those are your real heroes, folks. Those are your real heroes. It's not the sports stars. It's not the Hollywood. It's not the politicians. Those are the real heroes. Nobody talks about them every day. They're not on TV. They're not in the movie theaters. They're not in the tabloids. They work behind the scenes, hard work, rescuing people, putting their lives on the line. I mean, we got to tip our hats to those people. All right, we got to pay tribute to them. Very important. All right, see you tomorrow. Bye.